It's been a while since I've done a review of my InvestEngine account. And if you remember back, this was my stocks and shares ISA last year. And I really haven't been looking at it. But even before we do that, let's go and have a quick look and see what's been going on within some of the markets over the last year. If we have a quick look, we can see that the FTSE 100 hasn't been doing particularly well. It's down about 4% over the last year. The Vanguard FTSE All World, so VWRL, that ETF that many of us know and many of us will be invested into, it's up almost 11%, but with the rally of the Magnificent Seven, we are looking at the S&P 500 being up about 22% over the last year. So what all is driving this? There's an awful lot of people suggesting that interest rates may be on the way down. It might be summertime before we get that, but hey, who knows? Let's keep an eye out on it. And inflation is certainly starting to look a little bit better. But all of that is gazing out into the future, and as we always say, nobody knows what the future brings. And I suppose that also brings me on to this video isn't financial advice or recommendation to go out and buy any ETFs in this case. Past performance definitely doesn't guarantee future results, and when you're investing, you really do need to be aware that your capital is at risk and you may lose some of that money that you put in. Welcome back to the channel, and if you're new here, hi, I'm Mark of Desperately Seeking FI. Let's jump across and have a quick look at the app. As you'll know, I've now taken out my ISA with Trading 212 in this financial year, and one of the main reasons behind that is I wanted to dabble a little bit in investing into individual stocks. But on this platform last year, it was literally I just invested into a number of ETFs. But let's go and have a look at how they have all done. So the iShares UK Dividend, I must admit, this one hasn't done particularly well for me. It is down about 8.3%. It is paying me a yield of 5.5%, but is coming out with the highest total expense ratio of 0.4%. You will see that I did buy in when this was reasonably high. This one tracks 52 stocks within basically the UK. They all will draw their earnings from outside of the UK, but they are UK based. And you've got Rio Tinto, HSBC, Legal & General, Imperial Brands, and British American Tobacco. So that's two tobacco companies that have had a bit of a hard time over the last year or so, making up almost 8.5% of that. They are good dividend payers, and actually I do hold, of all of these, I hold 4 of those on my Trading 212 monthly dividend stock portfolio. No surprise, the S&P 500 is the one that has done me best over that time, and actually I have received £18.28 in dividends from this one, and then on the investment return, so on those dividends I'm getting a 1.22% yield on that. Also, total expense ratio, which I really like about this ETF, is coming in at 0.7%. Overall, almost up 12%, so I cannot really grumble at that, and we are currently sat at a ridiculous 71.86 for this ETF. And if we have a look at what has driven growth within this ETF, it won't come to a surprise to anybody who has been looking at what's been going on with the Magnificent Seven. We are looking at Microsoft, Apple, Amazon, Nvidia, and Meta all being the top 5 companies within this ETF, and they really have driven growth within this ETF. If you're getting some value out of this type of content, I'd love it if you could like and think of subscribing and turn on that notification bell so that you can get told of when I have published new material. If we then go and have a look at the VHYL, it's been a little bit bumpy over the last year, and this one pays 3.41% yield, and looking at that expense ratio starting to ramp up a little bit at 0.29, but paying me out dividends of about £25 over the last year. And then looking at the top 5 stocks are within this ETF, it's JP Morgan, Exxon, Broadcom, J&J and Procter & Gamble. I've done a video on Procter & Gamble where we look at Procter & Gamble against Unilever. Might be worth having a quick look at. And having said that, the FTSE 100 hasn't had a particularly good year. When we look at the returns, yes, that is down 4.39, but if we look at my total return for investing into this, I've bought in just under £32 and looking at being up 8.2%. FTSE 100 ETF within this portfolio makes up about 7% of the holding that I have, and on the dividend side of things I've received about £11 of dividends on there. What I quite like about this is the yield just under the 4% and the expense ratio coming in nicely at 0.09%. And then we will recognise all 5 of those big names, and these are big dividend payers through Shell, AstraZeneca, HSBC, Unilever and BP. I'd be interested to hear, have you got an idea of what you might do going into the new tax year? Are you going to take advantage of the fact that you can have more than one investing platform for your stocks and shares ISA, or are you just going to keep everything nice and simple and keep everything on one single platform? And then the final one, looking at the emerging markets, it has definitely been a bit of a bumpy ride over the last year for the emerging markets. China not really managing to drive forward growth as we were hoping for, but still getting a yield of 2.62 on this and an expense ratio of 0.15. On the dividend side of things, coming in, it gets a little bit better every time I get a dividend, just tiny growth on this one. And if we have a look at this portfolio as a whole, it's pulled in £173 of dividends over the time that I have held that, and reasonably happy. I will be reinvesting that back in. You will see that I have £25 in here. I've taken off that auto invest because I want to choose which ETF I want to buy more of. We're looking at total expense ratio for this portfolio at 0.23% and a dividend yield coming in okay at 3.37. This isn't actually designed to drive lots of dividend. I'm trying to get a bit more growth coming out from this portfolio, and it has been shown that it has had some growth over the past year. If we do a quick breakdown, we are looking at, it is probably still too heavily focused into the UK to get that full growth that we would have got had we had a higher North American coverage. If we then look at the sectors, also showing why growth hasn't quite matched what has been going on within the S&P 500, because we're very much into industrials and financials before we hit those tech companies. Holdings, that said, Microsoft is the largest holding, and that is coming in at 2.2%. We've then got HSBC, Apple coming in at third, Rio, Shell, British American Tobacco and Legal & General, Imperial Brands and Lloyds. So lots of companies that we do know, it's just we haven't got quite as many within the tech sector to drive enough growth in there. Why don't you go and have a look at this playlist that gives you a bit of a review on some of the platforms that there are out there. Thanks very much for watching, and I will see you in the next one. Cheers, bye.